All right. Thank you for joining this, I guess, evening, like late afternoon, evening. But hey, thank you for joining. My name is Katherine Jackson. I am the VP of Business Services at Far South CDC, which we are located on 115th and Halsted. The exact address is, 853, right? West 115th Street. We just moved. I'm going through, so we have a lot of addresses. And, but we are located on the far south side. And as far as the business, I'm going to keep it a little short just for the sake of time. But as far as the business services department, we offer a couple of things. We're a neighborhood development center with the city of Chicago. So if you have any information or just any questions about anything city related when it comes to licensing or different programs from the city of Chicago, we will help you out with that. Also, we are an Illinois Procurement Technical Assistance Center, or the new name is Apex Accelerators. And through the state of Illinois and the federal government, we help with procurement services, meaning that we will help with certifications, meaning MBE certifications, WBE certifications, and we have a state of Illinois certification program, which if you are looking to get into that program, I'm going to leave my information in the chat and I can answer any questions with that program as well. Also, just anything government contractor related, we will help you with that. But for the sake of time, I am going, these lovely ladies today, Florence Hardy, which is our own Far South CDC Chief Innovation Officer. And she has a whole bunch of other titles too. She does a whole bunch of stuff. Amazing stuff. And then we have Sharnell from CIBC, which is definitely the financial guru. She is the community development relationship manager, right, Sharnell? All right, a big title. She does big things, okay, people. And I'm glad that you ladies are going to be presenting the sources of financing today. And I'm going to turn it over to you ladies. I know you guys have presentations. Let me know if you're able to pull it up.
You should be able to see my screen now.
Yes, can see your screen. Yes.
Okay. So hi everybody. My name is Florence Hardy. As Catherine said, I am the Chief Development and Innovation Officer for Far South CDC. She talked a little bit about what we do there. So if any of those services sound helpful to you, please reach out to Catherine and she can direct you. Today, we're going to talk about how to find business funding. I'm just going to provide a brief overview of many of the sources that are available and talk in detail about one of them. And then I'll pass it on to Sharnell, who will finish it up. And at the end, we'll open it up for you to ask any questions that you might have. So when you talk about financing for a business, there are really two sort of primary categories that you need to discuss. The first is traditional financing, and the second is alternative. So first, we'll start with traditional financing. The thing that I like to say is that while you see here, there's sort of 5 general areas of or types of traditional financing, they don't always necessarily go in this order. That said, they almost always 100% start with yourself, meaning you have to have some money yourself to put into your business. There are some ways that you can start to bootstrap for yourself to get that money, but you have to think about, why would someone else invest in your business if you haven't invested in your business? So that's the first thing to consider. That type of financing is called bootstrapping, as I mentioned. And there are some ways in which you can save up the money yourself to start your business if you wish to do so. The second is friends and families and grants. This is as you start to move up in or move forward and progress in your business. Friends and family might be able to loan you or become partners in your business. And then there's also grant opportunities as well. What I do like to say about grants, I don't know that Sharnell will cover this, but grants are available. They have become more available as a result of COVID. That said, they also are more competitive and difficult to get. So, while they're more out there, there's still not a lot for startup businesses. The grants that are available now are primarily for businesses that were in existence prior to COVID March 2020. So if you've recently started your business, the well is running dry on grants. Then you have angel investors. These are wealthy individuals who invest their own money in businesses. The second is venture capital, or the next is venture capital, which are groups of people who invest the money of others. So it's not their money, but they may go out and get investment from pension funds or banks or a number of wealthy individuals. And instead of those entities investing for themselves, they'll give their money to a venture capital firm, which will ultimately make those investments for them. And then we have banks, and banks is last only because banks typically want some operating history. So you may, and Sharnell will talk about some of the earlier banking options that might be available for small businesses, but typically it's going to be later down the line that you're able to qualify for large loans to grow your business, anything over $100,000 or so. That's going to be about 3 years of operating history that you're going to need. So that's the traditional financing landscape, as it were. Alternatively, these are some other types of financing that exist. I'm going to talk about crowdfunding in detail, but there's also something called crowdsourcing, which is essentially crowdfunding, but it's more of a barter system. So instead of asking for money, if you need like chairs or something, you might ask your community to bring chairs. And so the crowdsourcing is the accumulation of resources outside of money in order to run your business. Client financing is the best type of financing that you have. This is essentially offering prepayment options for your client so they can pay you prior to you delivering the service and or product. This means that you get the money up front. A lot of businesses can't do prepayment options, but if you can find some way to get your clients to pay you before you deliver the product or service, that is a type of financing because you're getting that money up front. And in some cases, you can say you have to pay me and the service or product will be delivered in 30 days or 60 days or 90 days for that matter. Next is leasing. So this is where you don't necessarily need to pay for a product all up front, but you rent it, right? So you might rent your facility, you might rent your equipment or something like that. So the capital outlay is much smaller at the onset. And then lastly, there's supplier financing, which is instead of going to a bank for a loan, you go directly to the entity that is providing you the service or good, and they finance you. So what that tends to look like is if you're purchasing equipment, instead of going to a bank and getting a loan and then buying the equipment, you go directly to the equipment provider and see if you can get credit with them. And they'll finance it directly instead of having that middleman. So depending on the type of service that you need, your supplier may be able to finance the purchase of that product or service for you to enter in your business. But as I mentioned, I'm going to go into detail about crowdfunding. Oh, I do have it in here. Before I get to crowdfunding, then I do want to talk a little bit about bootstrapping. This is that, how do you get the money yourself if you're trying to start a business? So these are 5 ways that you can do it. In fact, most people start with their savings or credit cards to start a business. It's not the best way because, well, savings is a pretty good way, but credit cards is not the best way. Typically because of the high interest rates that credit cards have. But that said, if you have to start, there's nothing else that you can do. You don't have the savings. You may not have a home. Then you might have to start with credit cards. Beyond that, there's your paycheck. So we are very adamant that you should not quit your job as you're starting your business if you can help it. And then you put a little bit away from your paycheck to start your business. If you have a savings, you can pull from that. There's also the ability to pull from life insurance or retirement accounts if you have that with a previous job, so or a current job for that matter. You just need to be mindful that if you are taking out of retirement accounts or life insurance, that there might be fees and taxes associated with pulling that money out early. And I talked about credit cards already. We already know how those work. It's not the best, but it is available. as an option for you to fund your business. You want to, of course, make sure that you're doing it responsibly. And then lastly, there's home equity. So if you do have a home, you might be able to pull out the equity in your home. And in fact, a lot of small businesses start this way. Now, that said, this is a super big risk, right? If you're not able to pay that loan back, you might lose your home. So be mindful of that. But it is a way in which you can get the money yourself to start the business. And then briefly, I want to talk about grants. I talked about there's very few, they're very competitive. And that for the most part, they're very extensive applications. And of course, then you're not even sure that you'll get it after you've invested 30 days or 60 days applying. But that said, if you are looking for grants, there's some available on the government level. You want to make sure that you do searches on the federal, state, and city levels. In our office, Catherine is able to help you identify grants that might be available for you. For example, right now, there's one through Cook County that is available. So you want to make sure that you qualify for that. If so, then you apply for that. And then there's also competitions that are available. So business plan competitions, there are venture capital competitions, or all kinds of things that if you just put in a search on Google, you might find some grants that are available that you can apply for your business that are not government sponsored. But I want to talk a little bit more specifically about crowdfunding in general. So if you haven't heard of crowdfunding before, crowdfunding is is the method by which you raise money, specifically, so cash, different from crowdsourcing, right? Where you might be gathering some other type of resource. With crowdfunding, you're gathering cash from a number of individuals, and typically in small amounts, in order to reach your ultimate goal. Crowdfunding, you might get $100 from 100 people, and that's how you get to $10,000, right? That you need to run your business. So it's the culmination of funds from a large group of people. What most people don't know is that there's 4 different types of crowdfunding that's available. So if you look at the chart here, there are donation and reward on the left, and lending and regulation or equity crowdfunding on the right. The primary difference between the left and the right types of crowdfunding is that the left side of the crowdfunding table is unregulated, meaning that there's no government entity that's going to make someone or that is regulating these funding sources. So donation crowdfunding is like a Kickstarter, or not a Kickstarter, a GoFundMe, right? So I'm raising money for books, school, tuition, hospital bills. Typically, it's to support some type of cause, and there's no expectation of return because you are simply donating. Reward is pretty much the same, except that you do not get a financial return, you get some other type of return for the money that you're giving. So you might get the product early, or you might get a discount code, or you might get a t-shirt that as a thank you. So there is some return with reward crowdfunding, but essentially it's a donation as well, where they're giving you a nice parting gift. Because there's no equity or debt associated with these types of crowdfunding options, they are unregulated. You typically still need to go through a platform to manage that, meaning a Kickstarter, or like I mentioned, a GoFundMe if you're looking for a donation. One of the things that you want to note with this crowdfunding is that with donation, you're typically going to raise from people that you know, right? You're not going to raise for your business from strangers and they get nothing in return, right? Now, that could be, as we've seen with the Maui fires, like if it's a catastrophe that your business has gone through, you might get donations, right? But they're donating to help you get back into business or whatever it might be. But if you're generally just a startup looking to start your business, if you're going the donation route, you're typically just going to raise from friends and family, not necessarily strangers. With reward, you will likely raise from strangers given what the reward is, if people find it interesting enough. The average raise for reward crowdfunding, if you are successful in reaching your goal, is about $30,000, and it can take anywhere from 45 to 60 days to get to that amount. Now, if we're looking on the right side of the table, you have regulation and lending crowdfunding. These are regulated. You have to go through a registered platform to either raise debt or raise equity using the crowdfunding method, if you choose to go that route. So the primary difference, of course, between the two is that lending is a loan, right? So you're saying to your investors, because that's ultimately what they are, that you will pay back this loan at a certain interest rate over a certain time. Now, the benefit to that versus a regular loan is that you get to choose the terms of that loan, right? So you get to say, this is what the interest rate is going to be. This is how often I'm going to pay you, and so forth, as opposed to a bank loan where the bank is the one telling you what those terms are. Additionally, with regulation crowdfunding, that's equity. So that's you selling portions or ownership in your company to those who are investors. If you're able to do an equity crowdfunding raise, the law allows you to raise up to $4 million a year. That's the same is true for lending crowdfunding. So you can raise up to $4 million in a 12-month period. And the average raise is about $200,000 per company if you are successful. Now, that said, not every company that attempts crowdfunding, whether it's donation, reward, lending, or regulation, is going to be successful. Right now, the success rate is about 20 to 25%. So there is a lot of planning that goes into this option, but it still is an option for small businesses, because a lot of the bank criteria that you would need to raise isn't there for crowdfunding. And then the last thing I want to say about crowdfunding is that you can raise under two different laws. As I mentioned, especially if you're going debt or equity, you have to choose whether you want to raise under state law or federal law because they are regulated. If you're doing, again, donation or reward, you don't have to worry about law because it's unregulated. So there's laws that apply, but not specific to the crowdfunding. The laws that apply generally across all of the types of platforms are fraud. Like, so if you lie straight out, you have no intent on building this thing and you're raising money, now that's fraud. So that law would apply, but what I'm specifically talking about as it relates to unregulated is crowdfunding laws. So there's crowdfunding laws at the state level and the federal level, so you get to decide what you're going to raise under. Under Illinois law, you can raise up to $4 million in a 12-month period. Again, this is if you're doing lending or equity. Under federal law, you can raise up to $5 million. The primary difference there is that under Illinois law, you can only raise from Illinois residents. Under federal law, you can raise from residents of any U.S. state. And then as far as investors, there's also something that regulates what they can do under the law. So in Illinois, investors can invest up to $5,000 per company, while under federal law, that number is $2,000 per year. So that's a really big difference and something that you want to take in consideration if you're thinking about doing lending or equity-based crowdfunding. So if you can invest up to $5,000 per company, that means that as a company, you're able to raise more money from fewer individuals. You might get some $5,000 and so forth. Under federal law, as I stated, it's only $2,000 per year. So if I'm an investor in a federal campaign, I only have a wallet of $2,000, and I might ultimately decide to split that up between 4 different companies, which means the most that I could give per company is $500 as opposed to the $5,000 that's allowed under state law. So as a company, you have to decide what's the amount likely that your investor will invest and which law best facilitates that level of investment. So I saw that there were a number of questions. Sharnell, I'm done with my portion. I can go ahead and answer these questions, or we can just go to you and we can save the questions to the end.
We can take the questions. The only thing I would ask people to be mindful of is if you have a simple question, please feel free to ask it because we don't want anybody to lose their momentum and their thought. But if you need to go into kind of like a specific scenario that has to do with your business, then Catherine or myself can schedule something with people at a later time. I put my contact information in the chat if someone wants to follow up with me directly about something that I'm going to discuss. But as long as it's a quick question answer, we should go ahead and take them.
All right, so let me go ahead and look through these questions. Credit is a great strategy. Great job. Welcome to those. Welcome to those. Okay, so this question is, if I currently have a business that was established before COVID, but want to start a new one, should I make the new one a subsidiary so it qualifies for grants, although they are unrelated in industries? That is interesting. If they're unrelated, it's possible that the grant still won't apply. Typically, when you're applying for these grants, they're going to ask you for the financials of your current business and what you plan to do with the new money that you receive. So it is possible that would be allowed, but it is on a per grant basis. So you want to make sure that you look into what the criteria is, because some do limit what you can spend the money on should you receive it. The next question is, can you do both Illinois and federal crowdfunding at the same time? The answer is yes, but operationally, it's hard to do both at the same time. Typically, we have clients who do one and then the other, if they are interested in raising under both laws. The next question is recommended platforms for reward or donation crowdfunding. There are a number of platforms that you can use. There are some that are industry specific. So the things that you want to look to when you're trying to choose a platform include if they charge fees, what those fees are, what does success mean? So like I mentioned success a couple of times. For some of the reward or donation platforms, you have to raise all the money that you're requesting. And if you do not raise all of it, then you don't get any of it. So if your goal is $500 and you only get $499, you yourself better put in that last dollar or you won't get anything. While there are others that provide, as long as you reach 50% of your goal, you get to keep what you raise. So I would say do a bit more research. There are a number of platforms that are reward or donation based that you can choose from. And Keith is right, kiva.org is one source of that is donation crowdfunding. So the way Kiva works is they first start with your friends and family. And they say, if your friends and family is willing to invest in you, then we'll open it up to the public. So there's that. So for Aja's questions, we do not consult in selling equity in a startup. You would need to talk to an attorney who is, what is the word I'm trying to say? Who practices that area of law. So with that, I'm going to move it over to Sharnell, and she's going to talk about some of the more traditional types of financing that are available, as well as some alternatives as well.
Florence, do you mind leaving up your next slide? Because I want to use your next two slides and then I'll move over to mine, if you don't mind.
Sounds good.
Okay, so we have the 5 C's of credit. If you guys have ever listened in on any of these things, this is not going to be new information to you. But this is what really any lender and resource is going to be looking at in terms of you as an application for financing. So you have to kind of just take into consideration that this is just the rules that every lender is going to go by. So the sooner that you kind of just wrap your head around this is what it's required to be able to access capital, then you're halfway home. So when we're talking about the 5 C's of credit, they're going to look at your credit score. Most of the time, good credit starts at a level of 680 or better. If I had to guess what maybe the vast majority of people I know, I would say maybe at best 20% of them hit that benchmark. So I don't want that to be discouraging, because there are a number of resources, not just traditional capital that we're going to talk about, where if you don't have a credit score of 680 or better, we're done talking to you. The other thing that is very important, that is also the second biggest challenge to being able to access capital, is the collateral. Most of us, depending on what age you are, you may not have any of the things that lenders are looking for in terms of traditional collateral. 9 times out of 10, that's going to be real estate, equity in your home, possibly equipment, possibly vehicles. But when we're talking about collateral, we're talking about, what do I get as a lender in the event that you don't repay your loan? So that is a very important thing. There are some differences again in the programs that I'll go into a little bit later. Cash flow. Now, when we're talking about traditional lenders, they're going to be looking at, we expect you to be an existing business for at least a couple years, and we're going to be looking at your business tax returns and or financial statements if they are available. So, so the one thing that I want to say to folks, and I don't want anybody to feel a certain kind of way about it, I've had many instances where I've had conversations with prospects or existing clients, and they have said to me, Sharnell, my tax preparer advised me to not make my financials look as strong as possible because we want to minimize or mitigate my tax liability. If I've heard it once, I've heard it at least 100 times. And the only thing I'm going to respond to that piece of information is this. If you want to go that route, I get it and I understand it. However, you will probably never be able to access capital if that's your strategy. If you want to be able to apply for and be approved for traditional funding, you have to have financials that look strong, that look like you have made some money at the end of the year after all of your expenses have been accounted for. And if you do not do that, you will probably never be able to access capital. Now, there's a couple other things to keep in mind. If you are a very new business and only been in business for a couple years, it's not going to be at all unusual if your number is negative for the first couple years. But we want to see the numbers be trending in the positive and upward fashion. And if they're not, it will be difficult for you to access capital. So please just keep that in mind. The other thing, character. Now, my definition of character and my PowerPoint that you'll see in a minute is a little different than this definition of character. Character in terms of experience of owners, this is an absolute must. There is almost no exception where a lender is going to be comfortable lending someone money who has no experience in that respective area that they're going into. You can't tell me you're a truck driver, but you love cooking, so you want to start a restaurant. That's not going to work under any set of circumstances. The only time that could possibly work is if you say to me, Sharnell, I've been driving a truck for 10 years. It was a good job for me to go for. But my daddy is Harold of Harold's Chicken. I grew up in the business. I know the business. I all the way through high school, that was my thing until I realized I really didn't want to do that. So then I went the truck driving route. If you have actual firsthand experience in a business, that is what any lender wants to hear and wants to see proof of. If you have never worked in a business before, it is going to be very difficult to be able to access capital because of this rationale. If you worked in a business as an employee and maybe worked your way up to a management role, then you are familiar with the things that are happening in that business operation. If you have never worked in that business, then you know nothing and you're not going to be well prepared for the things that are going to come your way. So say, for instance, if you wanted to open up a restaurant, But if you don't know anything about a sanitation license and your employees have to have a sanitation license, so they have to pass that training, then you are not going to be well positioned to do the things and anticipate the things for you to be strong in your business. So the character and experience is an absolute must, even though a lot of people think it's not, it really is. And then the other thing is like conditions. So, I mean, the pandemic, you can't get any more conditioned than that. But another example, say for instance, you have a daycare business. Well, during the pandemic, a lot of daycare businesses and a lot of businesses where people traditionally get together and be in close proximity to have been severely hurt as a result of the pandemic and as a result of other things. So when you are getting into your business or considering your business, if you're a startup, these are the things that you have to think of. Also, another good example is how mature is the industry that I'm going into? There are some businesses that, there's a business life cycle. There's a start to the industry, there's a boom with the industry, and then sometimes the industry is going to mature and start to trickle off a little bit. Great example, books. Now, I don't know how old y'all are, but I have books. I still read books because that's what I grew up in. But like kids and young adults our ages, they did not grow up reading books the same way. When my son starts school next week, his books are downloaded on a laptop. So that is an industry, for example, that is maturing, and it's not going to have a whole lot of growth in the future. So that's the kind of thing that we're going to look at is how is that industry maturing? Is it approaching the end of its business life cycle? Because if that's the case, then a lot of the people who have traditionally participated and used those resources are probably aging and will not continue to be viable customers. So those are the kind of things that we ask you to keep in mind when you're deciding if you're going to start a business or if you're in that type of business. How do you pivot? How do you figure out, okay, I've been doing this for X amount of time, but now I need to shift because I want to take advantage of the customers that I don't have and still, be able to grow my business. So Florence, could you go to the next slide for me? So now this is what traditional banks look for. And when I say traditional banks, I mean the Chases, I mean the Bank of Americas, I mean the US banks. This is what business banking has looked like in the past. You must have good credit scores, that's 680 or better. You must have 20 to 30% of your own money or equipment or assets that you have contributed to your business, and you can show that you have that on your balance sheet to show a lender who is you're asking to consider you for funding. Typically, loan amounts 100, sometimes as low as 50, but somewhere on that level is what they're looking for, or what people have gone to banks looking for loan amounts of that amount. Typically, the term is going to be anywhere from 1 to 5 years. Usually, it's never going to exceed 5 years unless it's possibly real estate or a large equipment ask, and then they're looking for hard assets for collateral. And they are never going to be comfortable with new risky ventures. For example, even though marijuana and CDBG related products are fairly well received these days, banks are still not lending in those industries. So that's just an example of what you should expect in terms of if you're seeking capital. So Florence, if you want to go ahead and take that off, I will share my screen and go into my PowerPoint. Okay, can everybody see my screen? I hope so. Okay.
Yes,
so
we can see it.
Thank you. All right, so when we're talking about what the lenders are looking for, we're going to be talking about that capacity. And when we're talking about capacity, this is going to be kind of really to the advantage of a well-established business who has a few years of operating history, and you have a positive bottom line after your revenues and after your expenses have been taken out. They want to see what the business cash flow looks like, but we're also going to be looking at what your personal capacity is. So traditional lenders only look at the business operations and that's it. If you're a lender like CIBC, we're looking at your global capacity. So we do financing for startups, but under a very specific set of circumstances. And because we do that, we're not only looking at your business tax returns, because if you're a startup, you're not going to have those. But we are definitely looking at your capacity because we're looking at, okay, if the business doesn't have much revenue and therefore your bottom line isn't positive, then I hope you have kept your full-time employment, because if you have not, then we're going to be in a position where you don't have cash flow to be able to service any new debt. We don't know how you're servicing your current debt situation, but this is why if you don't at least have full-time employment, and with respect to that, your personal income, you still have something left after you paid your mortgage and your rent, your car note, student loan debt, credit card. Heaven forbid if you got kids, then you know you might not have a lot of money left after you get finished with them. So, but if there is something left after your normal expenses, then we can look at what you have available through that and what you might have available through your business. And that's what will determine if you have the capacity to be approved for a loan or a line of credit. So when we're looking at character, we're not only looking at what we discussed in terms of your experience in a certain area, but we're looking at your credit. And so again, we talked about good credit traditionally at 680 or better. We're looking at how you manage your credit. Now, our program is very different than most traditional lenders. In community development, which typically does not do small business lending, but at CIBC, someone could have a minimum credit score as low as 620 if they have not completed entrepreneurial training, but as low as 600 if they have. Now, before anybody gets too excited, I just need to explain the caveat. If you have a credit score of somewhere between 600 to 620, then you are not going to be able to qualify for a large dollar amount in terms of a loan and or line of credit. That is going to look something more along the lines of at maximum $10,000. And it could be a loan or a line of credit or a combination of the two. But just keep in mind that typically entrepreneurial training is going to be involved with that. And I'm going to touch upon that in a minute. But so we're looking at your credit scores. If you have had some instances where your credit score is below, say for instance, a 640, then there's going to need to be some conversation as to why your credit score looks like that. So you may want to have a letter of explanation prepared. You may, just be able to say, Sharnell, during the pandemic, I worked in the restaurant industry for several months. We weren't allowed to be in close proximity to people. So for several months, I wasn't able to take care of my obligations on a timely basis. It needs to be something that is reasonable. I met a close member of my family who we share expenses with. They were negatively impacted by COVID. So we didn't have as much disposable income or just as much income, period, to service our obligations. If it's something that's not like that, I'm going to encourage you to probably wait a little bit and hope that and work on getting your credit score stronger, because there is a direct correlation between the level of your credit score and how much you can qualify for. Again, the collateral that most lenders are looking for, I would say 90% of all lenders are looking for, are the real estate, equity in your home. If you have a business that has accounts receivable, they'll look at that, as well as inventory and equipment in your business. And then they're going to value it. So most of the time, just because you put that figure down, we're not going to believe that that's really the value unless there's like support documentation for that. So it's not at all unusual that, a lender will lend like based on 50, 60, 75, maybe 80% of the value that you've indicated your collateral is worth. But that is usually a challenge for a lot of folks, because most of the time, if they have collateral, it's nowhere near free and clear. or they don't have a significant amount of equity in it yet. So that's something else to keep in mind. Capital is what we are looking for you guys to have for your business. The one thing that a startup is not going to have much equity or account that's been accumulated in the business unless you really invested a ton of equity in it in the very beginning, which most people don't do. They will like start with a little something, and then when it seems like the business is very well received and there's a lot of interest in the business, then the revenue starts to grow. But it does take a while for the equity position to really grow in the business. So
credit wide or prep. Got it.
it's oh, okay. Somebody's up. Okay, so let's see. In terms of conditions, I think I talked about this a little bit already. So this is the thing that we want everybody to really walk away from this conversation, is knowing what it is you need to be prepared to access capital. So the thing that we're going to be looking at is, what do you need the money for? And what typically goes hand in hand with this is, do you need a loan or do you need a line of credit? A lot of times people will say, I don't know what the difference is. So if you know the answers to these questions, then you may not know which one you need, but we use the answer to this question to determine what it is you need. So if you know you need certain things right now to get the business started, like supplies and inventory, equipment, things along those lines, that is typically the type of things that people will use a loan for. And a loan is, you're applying for $5,000 at a fixed interest rate over a 2-year term, and the loan payments are going to be about $145. That's a loan. A line of credit is, I'm going to be approved for a $5,000 line of credit. I'm going to pay it and use it, kind of similar to a credit card. It's going to have a variable interest rate. And right now, there's a lot of volatility with the interest rate environment. So rates are much higher than they've ever been before. But if, say, for instance, you're a caterer, and you don't always need to have a certain amount of something, but when you get a catering opportunity, you know you're going to need to buy food, you're going to need to buy certain supplies, and you're going to probably need to have a couple of your people who come in and help you prepare the food and do all that stuff. That's kind of the nature of a line of credit compared to a loan. So as long as you know what exactly you need, and it's not unusual to only need one or need the other or need both. Everybody's business is different. So that is the kind of thing that you just need to know. I need it for this and that, and you need to be clear about what it is you need. Please don't give a dream list about what you think you might need if these things come to pass. Just go with, this is what I need for the moment to get my business running or take me to the next level. When you're preparing to meet with the lenders, doesn't matter which type of lender you're looking at, you're going to need your personal and business tax returns are number one and number two. It is nice to have financial statements. A lot of small emerging entrepreneurs do not have financial statements. They just have their personal and business tax returns. If you are a young business, a business plan is an absolute must, because we do not want to have to figure out what your business is. If you are an existing business and you have financials, we can kind of figure out what your operations look like. But if you are a very young business, the business plan is an absolute must, because we want to see what your thought process is about what your business is on paper, so we can review it, so the underwriter as well as the approving manager can review it as well. These are some of the other resources besides the traditional lender. Now, the real advantages of a traditional lender is typically we have better interest rates, we have locations that you can come to, we have multiple products that are available, like I said, the loan and the line of credit, a combination of the two, as well as a business checking account if you need that, as well as treasury management services if you need that. But if you are not at a level where you can satisfy what a traditional lender needs, then you need to be aware of the micro lenders. So in the Chicagoland area, there's three. One of them is the Women's Business Development Center, Access to Capital Program, Alliance for Community Business, used to be Axion, and Greenwood Archer Capital, which used to be Chicago Neighborhood Initiative Microfinance Group. Now, these are all community development financial institutions. They have programs set up to lend anywhere from $500 to $50,000. Actually, I think Allies for Community also have SBA low doc loans, so they could actually go up to $100,000 in terms of capital resources. But what they do is, hey, you guys aren't ready for a bank yet, but we know that you need capital resources. So we're going to help you either with a smaller loan or line of credit until you're able to get your situation together. So it's not at all unusual for somebody to get approved under one of those programs. They're going to require the same type of documentation as a traditional lender is going to require. But again, you have the opportunity to get something going with them. And they tend to be kind of generous. It depends on which one. I'll be honest with you, I'm terribly familiar with two of them. I used to be over the Women's Business Development Center's Access to Capital Program, and I actually sit on the loan committee for Greenwood Archer Capital. Allies for Community Lending, they are probably the one microlender that has the most experience in doing lending, but they're not the most generous in terms of giving larger dollar amounts. So you just have to have a conversation with all three, get to know which one you think, or get a good vibe off of their staff that you're talking to, and then you can kind of go from there. The other thing that you can possibly look at is factoring. So factoring is not a loan to you as a business. Factoring is, we're looking at this contract that you have with, say, Target. Target is willing to, for whatever your product is, they want to buy 20,000 units. They want to put it in the store. Factoring is not looking at your personal credit. They're not looking at your tax returns. They say, hey, Target, we know that they pay in these amount of days. We're willing to advance you this percentage of your contract value. Some things they will want in terms of, like, say, for instance, a lien against your business assets, which is something a traditional lender also will require. But at least you don't have to meet the same standards of what a lender is going to require of you. And it might give you just enough to get that contract met to really start to be able to grow your business so that your cash flows do look strong enough to be able to secure capital financing. So let's see, crowdfunding, Florence covered, factoring. The one thing
I was just going to add with factoring too.
Mhm.
She mentioned that there was a percentage. So if your contract with Target is $100,000, you might get 85 to 90 of that. Maybe you might get 80,000 of that you will not get the other 20. That is the money that the factoring company is keeping. So you're never going to get 100% of that contract because you use that type of financing. So I just want to put that out there.
Thank you, Florence. So that kind of gives you a sense of what the resources are outside of traditional lending. But just a little bit of information about what CIBC offers, because our lending that I'm discussing happens in the community development space. There is the accommodations with respect to credit. There are the accommodations with respect to collateral. And so with respect to both of those things, again, credit scores could be as low as 620 if you don't haven't participated in entrepreneurial training, and as low as 600 if you have. And just to give a sense of what those entrepreneurial training organizations look like, they include the Chicago Urban League, City of Chicago Business Affairs and Consumer Protection, YWCA of Metropolitan Chicago. I'm drawing a blank, but I can try and work on getting a list. Oh, Chicago State University, if you are an established business. Those are just a handful. Some of them are offered at very convenient times, and some of them are virtual. So if you are the type of person where it's hard for you to be at certain locations at a specific time, sometimes you have the option to still be able to sign up for this entrepreneurial training virtually. And then you can participate just like we're doing via Zoom in the comfort of your own home at a time that works best for your schedule. So if you are a startup, the maximum you can qualify for is up to $10,000. Again, it could be a loan, a line of credit, or a combination of the two. If you are an established business, and by established, we mean you have a personal and a business tax return, then we consider you established. But that, again, is going to dictate how much you qualify for, how much your revenues are of the business, and how much your global income situation looks like. So the loan is typically going to be fixed at an interest rate of 5.99%. Line of credit is going to be prime plus 4. And unfortunately, the application process will be repeated every year. And here's the rationale why. Every year, something can happen with your business that there's no way for the lender to know what's going on unless there's a check-in. So during that check-in, we're going to make sure that your credit scores are at least what they were when we extended the credit. We're going to make sure that your cash flow is continuing to operate. You're still in good standing with the Secretary of State. And if you are in need of more funding, that's the perfect opportunity to say, hey, this is what my tax returns looked like last year. I'm growing, I have these opportunities. I would like to be able to access more resources. So this particular program goes up to $30,000. This program, the Easy Path, is similar to the ETP, only that someone has not completed entrepreneurial training. You cannot be a startup and participate in the Easy Path. You have to be established, and you have to have 2 years of operating financial history to be able to use this funding. But I will be honest with you, there is no, generally speaking, good reason. I've had clients who have business degrees who have really had a lot of missteps because they didn't take advantage of things like entrepreneurial training to just give a lot more foundational information than what they were able to study and learn about on their own. The other thing is with ETP, you qualify for more. So a traditional lender is going to look at your revenues and say, we will lend you 10% of your revenues. So if you've been in business for 2 years and your max revenues are 45,000, then that means all you can qualify for is 4,500. But if you've completed entrepreneurial training, you could be a startup and qualify for 10. So there's 2 reasons there. You qualify for more money, and in addition to that, you can get learn some things that you probably would not know on your own just because you know your business and you know your service. In addition to that, you also can qualify for a Community Plus loan. This is a product for better qualified, more experienced business owners. If you have a credit score of 660 or better, then you can qualify for up to 100,000. But I'm gonna just be clear about this one. You have to have revenues of above, generally speaking, 50, 60, 70, $80,000 strong personal credit to be able to qualify for this program. And a lot of people don't have it, but there are advantages like the interest rate on a line of credit is prime instead of prime plus 4. So from that perspective, you have a lot of resources. I'm going to finish up because I know we only have 2 minutes. And the thing that I'm going to share with you guys on that is a promotion that we currently have available. And let me share that. So this promotion is currently available through October 31st. And the promotion is whether it's a loan or a line of credit for the first year, it's fixed at 4.99%. So the things that are required is you must become a client of CIBC Bank. You have to provide all the documentation that I've already shared. And in addition to that, we can, evaluate someone. Typically, the application process is 30 to 40 days or so to be able to apply for funding. And this is my contact information at the bottom. So the other thing I didn't mention are there no origination fees. There's no closing fees. And I am located in our Mount Greenwood branch, which is on 111th in Kedzie, but we also have locations in Bronzeville. We have locations in Little Village and downtown Chicago. So if someone is interested in learning more about the resource, I'm happy to have a conversation with them at another time. So I didn't know if there were more questions. I'm sure there might be. So
We had a question from Kenneth earlier. It was kind of specific to his situation. So I think, Kenneth, you were trying to figure out which option would work best for you. You would want to schedule an appointment with Catherine. Her information is in the chat, and she can go through your specific business type, the financials, the amount that you're looking for to help you identify which method might be best for you. Kenneth also asked, who does virtual entrepreneurial training? Sharnell, I don't know the answer to that question.
I know the answer to that question. So the city of Chicago, Business Affairs and Consumer Protection, they offer it and it's free. I think most of the time though, it's during the day. So that might be a little challenging for some folks. I know Chicago State's program is still virtual, but that particular entrepreneurial training is only for existing businesses. You cannot be a startup and take that particular cohort. The Women's Business Development Center, they also do virtual still. And I'm not sure about the YWA of Metropolitan Chicago, but if someone is specifically interested in entrepreneurial training and they send me an email and share with where they live and what their schedule looks like, I can try and do a little bit of homework in which entrepreneurial training programs have like are based where and serves which kind of clients, and it's either for established versus startups, or startup and emerging.
This looks like a question, I guess. It says Chicago Score Chicago does entrepreneurial training. That's possible. I don't know if it's included in your program.
They do advising. They do one-on-one advising similar to what you can get at any small business development center, but they do not provide a certificate in SCORE. So they would not be, but the SBA does have, it used to be called Emerging Leaders. I think they might have rebranded it, but they have their own entrepreneurial training, but it's not SCORE specific.
And then the last thing I will add before, if you have any other questions, if you are interested in crowdfunding, I did not mention this. I work with state and federal platforms. So if you're trying to figure out if you should do donation, reward, equity, or debt, you can send me an email. I'll put my email in the chat, and we can schedule an appointment to have that conversation specifically as it relates to crowdfunding. If you're wondering which options, in addition to or instead of crowdfunding, so the traditional methods that I spoke about earlier that Sharnell mentioned, you can email Sharnell about bank traditional financing and Catherine about all others to see which option might work best for you. So I know Catherine put her email in the chat. I will put my email in the chat. And then Sharnell, if you share your information, that's the best way to get the one-on-one support that you might need to figure out which financing option works best for you. Are there any other questions? You can feel free to unmute yourself, or you can type it in the chat.
Yes, I know also, I know Sharnell, you had mentioned that we can schedule a time together via Zoom, as well as Florence, to talk one-on-one about your personal situation.
Mm-hmm.
Okay, it doesn't. Oh, wait.
I was about to pose a question.
Yes.
I'm interested in the management of all the requirements. For instance, let's say you are an LLC, and then you have documentation that's due for the state, for the federal government, how do you manage all of that year after year after year after year?
So that is less a financing question, more than an operations questions. It sounds like, I want to make sure that I understand your question correctly. But that said, you can work with a counselor in our office to help you come up with an operations plan for your business to help you manage that. For the most part, small businesses, they just figure it out, right? You may enlist the help of an attorney or an accountant. You would then have to put them on retainer though, if they're managing those documents for you. So like an attorney would make sure that your annual report is filed, make sure that your contracts are up to date, help you with any documentation requests that you might receive. An accountant would help you keep your numbers in order, do your financials every year, etc. And so there are systems that are in place, like online systems where you can store your documents and even give yourself reminders that this document might need review on a regular basis. But that sort of operational question really goes into, how do you plan to operate your business? Every business owner is going to manage that document, that paperwork process differently. But like I was alluding to, there are online tools or project management tools where you can store all those things in one place and give yourself reminders.
The
Thank
one thing
you.
I always encourage people to do is, whether it's their loan payments, because I end up calling people if they haven't made their loan payments in a timely manner, is putting those things in your calendar, your personal calendar, so you know when your annual report is coming up for the Secretary of State for you to remain in good standing. You know when you have to do certain things at a certain time. A lot of people, especially if they're a startup or very small businesses, their kid ends up being their chief technology officer. They update the website. They're someone who has some kind of capability to do certain kind of management tasks, help people with that. And if you have a strong enough cash flow position, you might just look into getting yourself a either an assistant or a business manager. It doesn't have to be full time where it's all coming out of you, but it could be a part-time person, because as your business grows, you will need more hands, because you cannot wrap your hands around everything and make sure that it's done. That business dream team is humongously important as your business grows. And Florence mentioned a couple of them, but the small business advisor, the banker, the attorney, the accountant, and your insurance provider. You have to have those people if your business is going to grow and do well. And if you don't, you're not going to get that knowledge that you don't have to help you grow your business.
Thank you.
You're welcome.
Are there any other questions that we can answer?
As far as the CIBC, I'm actually not partnered, but I have worked with Sunshine Enterprises, and someone recently told,
Then mention Sunshine, one of the largest ETP partners that we have.
That's awesome. So I actually just learned about CIBC a week and a half ago, and I went online and I was just overwhelmed with all of the information that was there. And I do believe I called a number, but my question is, with the loan options for startups, I heard what you said, Ms. Sharnell. How long do we need to have been in business ideally as a startup? I know you're going to look at financial statements and weigh the whole picture, but I mean, what does an attractive profile look like, for, I'm just trying to gauge if I'm prepared yet or not, because I've been at this journey for a little over a year.
Well, the advantage of our program is someone has completed entrepreneurial training and have that certificate. They don't have to be in business yet. It's not a requirement that you're in business at this moment. It's helpful. I usually encourage people to at least have everything established in terms of, are you an LLC? Are you incorporated? Nobody wants to see a sole proprietor anymore. I know we grew up with those kind of businesses, but a single member LLC is definitely the way to go with respect to how you're organized. But I would say at least 6 months, at least. I would say you must have your tax returns completed. Um, you need to know what your credit score is, or at least be familiar with what it is. Because the one thing that I do is in my one-on-one, after having a conversation, I tell you if you can qualify for something, and if you can't, I refer you to a microlender. Because most of the time people just need something to get started. But you know, just it really depends on where that entrepreneur is and if they need money this minute, and can we get it for them, and if not, where they can go to get it. Because at the end of the day, it's great to work with a lender who wants to work with small entrepreneurs, but if you have an opportunity and you need the money, then sometimes CIBC can't make that happen, and we're more generous than any other lender in terms of a bank. Right.
And just really quickly, because I know others may have questions, because the location I was trying to get in touch with was the Bronzeville location, but I just heard you say you're on 111th and Kedzie. Did you already share? Did you already share your booking link or your email, or is it just?
Yes, mine is in the chat. It's a little bit higher up. And what I will do also is share that flyer with Catherine, and that also has my contact information about the promotion. Currently, the gentleman who was in our Bronzeville location left the bank about 6 weeks ago. So at the moment, I'm covering for Bronzeville as well as the location that I'm in on 111th. So typically, somebody goes into that branch, they're still going to get referred to me.
And I know Sharnell, we had mentioned again, like if we need to schedule one-on-ones, we can do that via Zoom as well. And of course it's being recorded. Also, I'm gonna have both of the ladies' information in that email as well with the recording link too. I know we don't have too much time left, but I know I see a couple of questions right now in the chat right now. Johnny, okay, I completed the JP Morgan Chase Minority Business Accelerator Program. Does this count with training with CIBC?
It's not one of our partners.
Not one of the
But the thing is most of these programs, especially like the City of Chicago one, they are not lengthy programs. They're typically somewhere 8 weeks or less. And with the City of Chicago's program, because it's virtual and kind of on demand, someone could actually do that within a month if they were highly motivated and had the time to participate on their workshops. But it doesn't have to be a lengthy process. We have some partners that have programs that are 8 months long. I don't see the purpose of that. I don't recommend people to those. But it just is a matter of if you find a cohort that works with your schedule, that works with your budget, that then take advantage of it. But the JP Morgan Chase is not one of them.
Yeah. And also, I would mention that I did used to work for the City of Chicago. I know Florence did this as well. And I used to help facilitate those entrepreneurs workshops that used to happen on Wednesday and Fridays in person. But I know they got everything virtual, and they do give you a certificate to go to CIBC and other partners to show that you did entrepreneur training. And it was free. Everything is free.
Yeah.
I'm not sure if we have any more questions. I know we have like 2 more minutes. Does anybody else have any more questions? Sorry, my voice keeps going in and out.
You guys are full of knowledge and information. Thank you.
Most definitely. I mean, they are amazing, right? Everybody. So like I said before, this is being recorded, and let me stop that right now, actually. And you will get the recording along with the amazing ladies, Florence Hardy and Sharnell Curtins Martin. And you will get all the information. I know, Sharnell, you said you're going to give me that information, the flyer. And also, I'm going to share, Florence, your information if people have any questions. And if you want to schedule an appointment, my email and my information will be in that email as well, along with if you want to schedule a one-on-one, just let me know. And I appreciate everyone for attending today.